Hello friends and subscribers, welcome back to another edition of Readings in Impact Investing. This is a podcast started by myself, Daniel Rosehill, and the aim is to take written material in the field of impact investing and replicate it in audio so you can listen to it rather than read it. The podcast can be found online at readingsiниmpact.org, that's org. And it also duplicates onto YouTube. Each episode gets automatically published there. So if you prefer to listen to material through YouTube for whatever reason, you can do so. The YouTube channel is called Readings in Impact Investing. Today I wanted to read an article from Performance Magazine, which is put out by Deloitte. This is from their issue number 43. It was published on the 11th of January 2024. It came up in my Google alert this week. And it's written by Ophélie Peypeux, Director of Investment Management Services for Deloitte France, and Isabelle Janakin-Morin. She is the Director of Impact Finance and Sustainable Development at Deloitte Switzerland. So this is an introduction to what impact investing is, which is obviously a little bit more fundamental than most of the episodes we've had in the podcast to date. But I thought I would record this because... well, there's a lot of articles about ESG versus impact, and there's been a lot of kind of repetition in that. But I actually thought this was quite a good overview. So for someone who is new to impact investing and wants some basic questions answered, like what's impact and why is it different than ESG, to cite a very common question, I thought this might be helpful. Okay, I'm going to start reading now. To the point. Investors are increasingly putting sustainability at the top of their agenda and recognizing that factoring in ESG considerations, ESG of course being environmental, social and governance, can help to mitigate investment risks and support companies actively driving sustainable transformations. Many investors have already adopted a range of strategies, from excluding high-risk companies or tilting portfolios towards companies that score better on ESG metrics. Some investors are now exploring opportunities beyond ESG and turning their attention to the real-world impact of their investments to address challenges in areas ranging from climate to inequality and healthcare. In this first article of a series on impact investing, we look at the fundamental difference between ESG and impact, the recognized standards in the field, and emerging regulations in Europe. What exactly is impact investing? The world needs companies that can drive positive change at scale through innovative products, services, and business models. Impact investing can spur the growth of such companies and help to advance solutions to address the social and environmental challenges which the world faces today. Impact investing has been defined by the Global Impact Investing Network, or the GIN, as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. To complement this definition, the GINs developed 4 core characteristics of impact investing to outline what constitutes credible impact investing. And these are the 4 core characteristics. 1 is intentionality. Investors intentionally contribute to positive social and environmental impact through investment alongside a financial return. This includes setting transparent financial and impact goals, and articulating an impact thesis that is explicit about these goals and the strategies used to realize them. The second core characteristic is impact measurement. Investors use research-based evidence and data to inform and quantify the impact of investment decisions. This includes setting targets about an investment's contribution to impact and identifying factors to gauge performance against targets. The third core characteristic is impact management. Investors use impact performance data in decision-making to manage investments towards achievement of social and environmental objectives. This includes identifying risks to achieving the stated impact goals and disclosing actual impact performance to investors and investees. Finally, there is collaboration. Investors take action to enable more investors to make impact investments effectively. This includes committing to using shared approaches and standards for describing impact goals, strategies, and performance. Building upon these core characteristics, other initiatives have emerged to provide clear reference points and help investors to understand the essential elements of impact investing. Where does impact investing stand on the investment spectrum? From an investor's perspective, sustainable and impact-oriented investments embrace a broad range of strategies, from responsible investing to philanthropy. Responsible and sustainable investing. Investors evaluate how companies manage risks and opportunities around sustainability issues. ESG factors set the minimum threshold for responsible and sustainable businesses. Thematic investing, investors focus on specific themes or trends where environmental and social challenges create new market opportunities. Thematic investors seek out companies that are well positioned to benefit from these trends, with the goal of generating returns from the growth of these companies. And finally, impact investing. Investors go beyond ESG and a thematic approach. They set measurable environmental or social goals and seek to achieve them with their capital via the projects or companies they invest in. So just to clarify what was just stated there, responsible and sustainable investing as a basic bar, usually based around exclusion criteria on ESG factors, thematic investing, focusing on specific themes or trends, and then impact investing as going beyond those two things. And there is a diagram that they have here, a very nice one showing traditional investing as being finance only. They're just looking for market returns. Responsible, sustainable, thematic investing growing on that, and then impact investing being further along towards the impact. They also have impact first investing and philanthropy. Actually further along the impact only course than impact investing, and that's because impact investing also focuses on financial returns. So perhaps in a future reading we'll do a look at this very interesting territory delineating space between impact investing and what they call impact first investing and philanthropy. Philanthropy is understandable, but impact, and just to underscore the differences here, we're talking about impact investing being impact, risk, return, and then the ones that they typify as being more impact than impact investing are ones where we're just looking at impact and we're not looking for a financial return, or it's less important. An example is philanthropy, where a philanthropist does not expect a financial return at all, generally. What are the main differences between ESG and impact investing? Difference number one, public versus private market. As ESG investing relies on ESG data that are mainly available for publicly listed companies, ESG approaches are more common in the public market. On the other hand, impact investing has traditionally been focused on private investment markets. This is largely because these asset classes allow investors to directly fund and support the growth and development of impact-driven companies, and therefore gain a clear understanding of their contribution to the overall impact being generated. ESG versus impact evaluation. While sustainable investing aims to screen companies based on their ability to manage ESG issues or risks, impact investing seeks to select companies based on their ability to deliver a specific environmental or social impact. ESG investors therefore rely on third-party ESG data to categorize investments, while impact investors rely first on evidence-based research to map and assess the positive outcomes of an investment and then collect data to monitor impact performance. Finally, we have benchmark versus forward-looking approach. ESG ratings and data, which are provided by third-party companies, aim to reflect the ESG performance of companies based on their annual sustainability reports, therefore their past performance and progress to date. Measuring impact in the investment process, on the other hand, requires investors to quantify the impact that a company in which it invests can generate. What are the relevant industry standards for impact investing? Despite the increased interest in and number of product launches claiming to be impact investments, there has been little alignment on how to manage investments for impact and the systems needed to support this. This has created complexity and confusion, as well as a lack of clear distinctions between impact investing and other forms of sustainable investing approaches. Since 2019, industry standards have emerged providing clarification for what constitutes an impact investment, helping to mitigate the risks of impact washing. The International Finance Corporation, or IFC, has developed the Operating Principles for Impact Management, acronym OPIM. These principles establish a common discipline and market consensus around the management of investments for impact. There were 58 founding signatories in 2019. Since then, the number has nearly tripled to 163. Spanning 38 countries and representing $470 billion in impact assets by year end. The OPIM provides a reference point against which the impact management systems of funds and institutions can be assessed. OSIM also promotes transparency and credibility by requiring annual disclosures of impact management processes with periodic independent verification. In France, the Institut de la Finance Durable, IFD, formerly known as Finance for Tomorrow, developed an impact charter to promote transparent impact finance and harmonize practices. The impact charter is built upon the key principles of intentionality, additionality, and impact measurement, and defines a common framework for all asset classes, existing funds, or new funds wish to be designated as impact funds. Based on these principles, an evaluation grid has been developed to assess the potential contribution of a fund to sustainable transformation. It's important to note that all funds to which this charter applies will endeavour to be classified as Article 9 within the meaning of the SFDR. And we'll talk about the SFDR just in a bit. That's the Sustainable Finance Disclosure Regulation in the EU. The Sustainable Development Goals SDG impact standards are another voluntary internal management standard designed to help investors embed the SDGs into their management systems and make high-level impact management principles actionable and guide the choice of which methodologies and tools should be used to appropriately measure and manage SDG impact. Can we consider Article 9 SFDR funds to be impact funds? This is referring to funds which are classified as being Article 9 under SFDR, which we talked about in a previous episode. An Article 9 fund is not an impact fund by default. It is defined by the Sustainable Financial Disclosure Regulation, SFDR, as having a sustainable investment as its primary objective. A sustainable investment needs to satisfy three criteria: contribute to an environmental or social objective, do no significant harm to any of those objectives, that's called DNSH, and finally follow good governance practices. As these funds are considered the greenest funds in the marketplace, they are often assumed to be impact funds. The confusion may also stem from the SFDR text itself, as Article 9 funds are referred to as financial vehicles which have as their objective a positive environmental or social impact. However, the SFDR requirements for Article 9 funds do not fully align with the core characteristics of impact investing as set out by the GIN. Above all, SFDR does not fully distinguish between the sustainability impact of the company in which the fund has invested and the investor's positive influence on that impact. In addition, SFDR introduced concepts like DNSH analysis and principal adverse impacts monitoring without addressing investors' core investment and process duties to generate a positive impact. Will regulators step up scrutiny of impact washing? The practice of making misleading impact claims, so-called impact washing, carries significant risks. In a sign that regulators are taking the problem seriously, the three European supervisory authorities launched a call for evidence on greenwashing, which questions, among other issues, the risk of impact washing. Early June, the ESAs published their progress reports in response to this consultation. In particular, the European Securities and Markets Authority, ESMA, has been assessing which areas of the sustainability investment value chain are more exposed to greenwashing risks, with a key focus on misleading claims related to impact. Misleading claims about real-world impact relate to product-level claims, as well as to entity-level claims. Some of the most frequent misleading claims relate to exaggeration based on an unproven causal risk between an ESG metric and real-world impact. These often consist of implying that ESG metrics mean more than what they actually do. In most situations, impact claims often would lack clarity of what impact is expected and how it is considered. Impact claims also often lack essential information about the main aspects of any impact framework, which are intentionality, additionality, and impact measurement. Impact claims can also stem from a confusion about the impact strategy. ESA's final reports on greenwashing will be published in May of 2024 and will consider final recommendations, including on possible changes to the European Union, the EU, regulatory framework. In November 2022, ESMA also published a consultation paper on guidelines in relation to funds names using the word impact or impact investing. In the UK, the Financial Conduct Authority, the FDA, will introduce in Q3 of 2023 a package of measures aimed at clamping down on greenwashing. So I'm guessing this article was actually written before it was published here. This includes sustainable investment labels, disclosure requirements, and restrictions on the use of sustainability-related terms in product naming and marketing. A new sustainable investment labeling regime for investment products will be implemented with 3 labels: Sustainable Focused, Sustainable Improvers, and Sustainable Impact. Products with sustainable impact will have an objective to achieve a predefined positive and measurable environmental and/or social impact alongside a financial risk return objective. In the US, the SEC is similarly working on rules for greater clarity. It has proposed ESG fund definitions and distinguished between ESG integration, ESG focused, and ESG impact funds. There is currently little clarity on the extent to which firms are making exaggerated or misleading sustainability-related claims about their investment products. A recent study from Novethic has, however, analysed nearly 200 Article 9 French funds and warned that a large majority of investors currently using the term impact or publishing an impact report do not meet the key characteristics of impact investing. Conclusion. As investors are turning their attention to impact investing, the need for a common language to combat the risk of impact washing is on the rise. The next articles in this series will look at the greatest challenges and best practices across different asset classes. The impact investing landscape is complex yet vital to create measurable value for your stakeholders and build a more sustainable future. Deloitte can support your company in developing a comprehensive impact investing strategy, which includes mitigating investment risk, identifying investment opportunities, and accelerating your sustainable transformation. Contact us, that's Deloitte, to discuss how they can help you guide your company to drive both financial returns and positive impact. I hope that was a useful article that I read. That was by Deloitte, the first article in their what they call their impact investing series, setting out the basics of the landscape of impact investing. Thank you for listening to another episode of Readings in Impact Investing. If you got value out of this episode, please consider telling your colleagues about this podcast. And if you want to get in touch with me to send me a report to read or a good article, I would very much welcome that. Public@danielrosehill.com. Thanks for listening. Until the next episode.